Imagine this for a second. What if everything you've been told about AMC going bankrupt was actually the exact opposite of the truth? What if the very headlines that scream doom and failure were nothing more than distractions, while behind the scenes some of the largest institutions in the world quietly kept buying more shares? Today, I want to walk you through exactly why AMC is still sitting inside one of the strongest accumulation zones we've ever seen. Why institutions and retail investors alike keep loading up, and why the fear-mongering you see online is nothing more than noise designed to push you out of your position. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads, and also enter our giveaway. But everyone, remember, this is not a financial advice video. Now let's start with this. For over 5 years, people have been shouting the same thing: AMC is going bankrupt. Yet, despite all of that talk, what has actually happened? Not only has AMC survived, but institutions have continued to increase their positions. Think about how contradictory that sounds. On one hand, the headlines say the company is failing. On the other, the biggest money managers are accumulating more stock. Ask yourself, do you really think billion-dollar firms are buying something because they believe it's worthless? Of course not. They're buying because they see opportunity, and in their view, the potential upside is massive. This is exactly why we call it the accumulation zone. It's the period where institutions and smart investors quietly load up, while the mainstream narrative tries to scare retail into selling. You'll see ridiculous titles like AMC is going bankrupt, avoid at all costs, while at the exact same time, hedge funds and asset managers are filing disclosures that they've added more shares to their portfolios. It's a game, and once you notice the pattern, you can't unsee it. Let's talk about potential returns for a moment. Many of us in the retail community have long believed AMC could deliver a 100x, 1000x, or even higher return if true price discovery were allowed to take place. Now, that might sound extreme to someone new, but consider this. AMC isn't just a struggling movie theater chain like the media wants you to think. It's the largest player in its industry. It has survived one of the most challenging business environments in history, and it's positioned for growth in multiple revenue streams. Compare AMC to smaller peers like IMAX or Cinemark, companies with far fewer screens, less brand recognition, and smaller reach, and you'll see their market caps don't make sense relative to AMC's. That disconnect alone tells you something is off, and that's before even factoring in the layers of synthetic shares and dark pool manipulation we know are in play. And here's the thing. Retail has known this for years. Apes didn't just buy into AMC blindly. They recognized early on that this was an opportunity unlike anything else in the market. We've been buying consistently, without hesitation, because we understand that these lower prices are not a reflection of AMC's actual value, but rather a result of deliberate price suppression. This is why you'll often see tweets and posts from everyday investors proudly saying, "I'm buying more at 287 cents and I'm never selling." They recognize the gift they're being handed. If the market makers are willing to sell them shares at these artificially low levels, they'll keep stacking their positions until true price discovery is forced to occur. Institutions see the exact same thing. They know they're not investing in a bankrupt company. They're investing in one of the most asymmetric opportunities available, the chance to turn a relatively small amount of capital into multiples they could never find in traditional blue-chip stocks. And that's why they continue to load up quietly, while at the same time, the media they fund pushes out stories designed to shake retail investors out of their conviction. Let's take a moment to address dark pools. This is one of the most obvious signals of desperation from short sellers. Nearly 70% of AMC's trading volume is routed through dark pools, compared to an average of about 34% for the overall market. Think about what that means. Why would so much of AMC's volume be hidden away if not to suppress the price? If short sellers weren't trapped, if there weren't billions, possibly even trillions on the line, they wouldn't bother spending the money or the effort to manipulate AMC to this degree. The extreme levels of dark pool usage, synthetic share creation, and failures to deliver aren't just random quirks. They are evidence of a battle that shorts cannot afford to lose. This is why even if AMC were to shoot up suddenly to $50 or even $200, it wouldn't cause mass selling. Some investors would take profits, sure, but the majority of apes and long-term holders would continue to hold, and many would even buy more. That's because they know that $50 or $200 is still nowhere near AMC's true value once real price discovery is allowed. This terrifies shorts because they know that once momentum shifts, it will be nearly impossible to stop. Now, when you combine all of this with the fundamentals, the case becomes even stronger. AMC has proven its resilience and continues to attract both retail and institutional investors. It's not just speculation anymore. The fundamentals are improving, the debt situation is being managed, and revenue streams are diversifying. The so-called short thesis that AMC is a dying company simply doesn't hold up against the actual numbers. And when a company's fundamentals improve to the point that the short thesis no longer exists, short sellers are living on borrowed time. Elon Musk once said that short sellers betting against Tesla would eventually be obliterated, and that same principle applies here. If shorts don't exit before AMC hits a new phase of growth, they will be crushed under the weight of their own positions. We also have to factor in the banks. Recently, we've seen banks seize collateral worth tens of millions of dollars from companies and executives who were unable to meet their loan obligations. This matters because large financial institutions are deeply tied into the short positions on AMC through lending, swaps, and other complex financial instruments. When loans start being recalled, when collateral gets seized, and when liquidity dries up, the house of cards begins to shake. That's the situation many of these short sellers are walking into right now. And here's the bottom line. AMC has become more than just a stock. It's a symbol of retail versus Wall Street. It's a play that institutions secretly respect, even while publicly trying to discredit it. It's an investment where the community has stayed united for years, refusing to let go, and that unity has forced shorts into a position they can't easily escape from. Every fake headline, every dark pool transaction, every synthetic share only pushes us closer to the inevitable moment where price discovery can no longer be suppressed. So as we look forward, understand this, the clock is ticking. Institutions are accumulating, apes are holding, shorts are running out of options, and the fundamentals continue to improve. If you've ever wondered why there's so much effort to scare retail away, it's because the other side knows how this story ends. It ends with shorts forced to cover, with institutions demanding a fair market, and with AMC finally being valued for what it truly is. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.